Okay, so emerging markets over the last number of years have been reasonably interesting and have been something of the darling for investors when we've seen a bit of a global sell-off elsewhere. But obviously we've seen some volatility over the last maybe year to 18 months. Perhaps we could see some backstory on how this has happened and what sort of factors have led to this volatility in emerging markets.
Well, I think clearly the bottoming out of the dollar in 2010, in 2011 or so, is probably the big one. Over time, emerging markets and developed markets have each taken turns at having their day in the sun. And for much of the last decade, it was a story of dollar weakness and emerging market strength and developed market weakness. Now, I think we've entered another period in which developed markets are holding sway again.
Would you not maybe say that perhaps the fact that we are seeing a pullback in quantitative easing from the Federal Reserve, that obviously funding costs are going to be a little bit higher for them, and of course we're still not really clear on the end game from the Federal Reserve, with Janet Yellen being rather reluctant to commit, other than maybe last March, in respect of when we'd see heightened interest rates from them. So from that point of view, like sure, yes, there might be opportunities there, but there could be a few road bumps to meet us if we don't get a bit of clarity on where monetary policy is going.
I think clearly the tapering of QE and the final and the end of QE as of maybe November is bad news for emerging markets. So yes, I think we will get more bumps, and I think maybe the rally we've seen in recent weeks will be reversed.
I think that's absolutely right for last year. We had a lot of the rally in emerging markets of the past 3 years was due to a hunt for yield, where we had in global markets investors coming into emerging markets in unprecedented size. Until the crisis, emerging markets were really a specialist investment sector. After the crisis, we saw a lot more core markets money coming into local currency and credit markets of the emerging markets. Last year, there was a concentration of positions, which last year came a cropper because of the beginning of concern on QE being unwound. I think that since then, we've seen a big washout in the amount of core markets money that is invested. We've seen positions have declined significantly in emerging markets, and the next big risk is less about the direction of core markets monetary policy, more about the actual stories in the emerging markets themselves. So we saw, for example, China concerns coming through throughout 2013. We then had political problems in Turkey. We are now seeing political problems in Ukraine, of course. So going from a broad sort of macro theme being a danger to emerging markets to the actual micro stories in each country. And part of the reason for that is the vacuum, the power vacuum from the US in particular and from the other big Western powers who traditionally dominated the political scene globally. There is now some withdrawal from that, and the emerging markets therefore don't have this sort of guiding political force in the world, and their volatilities are increasing. So we have the risk of more and more political volatility stories, if you like, coming up in various big emerging market countries. I think that's the main, for me, that's the key risk we see in the next few months to years. In terms of the Fed and what we see in Europe, yes, the emerging markets are clearly linked to the direction of core markets. But if we look at the last few weeks, we've seen a big sell-off in peripheral markets in Europe. We didn't see any such sell-off in the emerging markets, really. We've had a few credit wobbles in Russia because of the Ukraine, but we haven't really seen a negative response to what would usually be perceived as a big sort of outside risk to EM, the sell-off in peripherals. So far, they've traded pretty well. So I'm quite confident that while there is political risk in emerging markets, at the moment, the impact from what may happen in core markets is somewhat muted.
But in respect of that, I think obviously I'm of the view that the peripheral market sell-off is mostly down to Draghi rather than any real confidence in a recovery and the deflation risks and the fact that we might actually see some action from them next month in respect of the rates and of course possibly some QE later on down the line. But other than that, I mean, we can leave that aside for the time being and see how that one works out. But China does appear to have been one of those big stories, the second largest economy in the world. There have been, I suppose, speculation that they will overcome overcome or surpass the US in the near term to become the biggest economy, and yet we are seeing growth slowing. Do we have to get used to lower growth? Are we going to have to come away from double-digit growth from China? And is what they're doing actually working? They're starting to focus on internal consumption rather than, I suppose, the export-led sector that really was the real thing that was driving the force there in China.
Well, I'll just say the following two things. The first is I'm not an expert on China, so knowing the economic outlook on China clearly is slowing. There's clearly the bullish sentiment we've had for what is now 10 years is starting to slow down. And to me, that was what was priced in last year. So the China slowdown story has been in the emerging market story from the beginning of last year. It was priced in and started to cause some of the wobbles we saw, particularly in June last year. So the other emerging markets, the South Africas, the Mexicos, the Brazils, the Eastern Europes, are very clearly linked, especially the Southern Hemisphere ones, are very clearly linked to the China story via the vector of commodities. To the extent that China slows down further, of course, emerging markets are going to be impacted. But we saw a lot of that come into the price last year from June onwards. So where we have benchmark bonds in South Africa, for example, historically trading at 6 to 6.5 to 7% at the beginning of last year, now they're trading more at 8.5 to 9%. So we have a lot more risk priced into these markets at the moment. We've had a lot of political risk priced in thanks to the Turkish situation at the beginning of the year. The Ukraine situation seems to be more isolated to Eastern Europe. We're not really seeing a huge impact on the other emerging markets. And China, to me, is a story which, yes, if it takes another leg down, will impact EM. But a lot of what we're talking about now is already in the price of some of the majors, I would say.
I think clearly the time to buy emerging markets, or one of the best times, is when they're clearly very, very cheap. As a collective whole at the moment, emerging markets are somewhat cheap. If we look at the MSCI and World Index, what's interesting is some of the individual markets are actually very expensive right now. One of my favorite things is to use the 10-year price to earnings ratio. You look at markets like Colombia, Indonesia, Malaysia, and the Philippines. These are four of the most expensive markets of all, which are up there along with the likes of the US. Now, I don't see how you're going to get meaningful good long-term returns when you start from those sort of levels. I think you've got to start from a collectively low level. Where is their value right now? China. But who wants to take the risk?
As far as the equity markets are concerned, I would have to agree. I mean, there's a lot of very expensive markets out there, but you could argue the same in the core markets as well. I mean, from a fixed income standpoint, what differentiates the big liquid emerging markets, all things relative, but the Mexicos, the Polands, the South Africas, from core markets is that whereas core markets have an actor buying bonds, manipulating the market in quotes, in the emerging markets, the central bank has no ability to do so. So in a way, quantitative easing is priced in obviously into the yield curves of the core markets. We have very, very low yields. In emerging markets, we have very, very steep yield curves, precisely because the central banks of the emerging markets cannot manipulate them. So in a way, we could say that the emerging market yield curves provide a better benchmark, a better pricing in of the unwinding of QE, simply because they don't have an actor manipulating those long-end bonds. They represent the global markets risks of QE unwinding better than the core markets themselves. So to that extent, I think that there is quite a lot of risk in the fixed income markets of the emerging markets. Yes, the equity markets are driven partly by the QE, which bubbles through to the core markets, and the same core markets investors then diversify into emerging markets. I don't think that there has been the same sort of level of washing out of positions in equities, simply because if we look at the risk measures, if we look at the amount of standard deviations that fixed income markets moved in June last year, they were 2008 style. In other words, they blew all the VaR measures, and we had a lot of unwinding of positions for that reason, simply because risk department had to do so. Equity markets didn't have the same amount of, sure, they were volatile, sure, they went down, but not in the same sort of risk-adjusted terms as the fixed income markets. So there wasn't as much of a panic washout in the equity markets of EM as I think there have been in the fixed income markets, which is why personally I think that the fixed income markets offer a moderate amount of value here in emerging markets, even in a scenario where we have core markets unwinding, core market yields moving higher.
And yet we have seen some currency intervention from some of those countries that you've listed. Particularly, I suppose the most recent one would be in Russia, in a bid to, I suppose, save what was quite a sinking ruble. In my view, I think, I suppose, the political storm over there hasn't really had so many ramifications over the global equities or even fixed income for that matter. And yet you kind of feel that it's on the cusp of something, that we might actually see something of a storm in the making. Do you feel that maybe it has been pushed under the carpet and that we've got something left to give or to see? Or are we politically stable? I mean, obviously we don't think politically stable, but can the markets weather the particular storm and the imminent storms?
Well, I just view that the political risk is moving around the Mediterranean, and we're now seeing it hit. We've had it in North Africa, we've had Egypt, we've had the Middle East, which of course all of these things are still brewing there, but we're moving around the Mediterranean. So to me, the risk is to Europe more than it is to the faraway emerging markets of the Southern Hemisphere. Obviously, if the global context becomes more risky, then all emerging markets will be affected. But putting all emerging markets in one basket, I think, is wrong here. I'm very worried about what's going on in the Ukraine. I'd be much more worried about how that impacts Eastern Europe. I'm very worried about what's going on in Turkey. I'm less worried about what's going on in Latin America, South Africa, or indeed Asia, simply for the reason that a lot of the risks are already priced, in my view.
Now, would you form the opinion that perhaps the recent sort of volatility in emerging markets has maybe forced the hands of some of the policymakers? And I speak specifically in regards to India, which has seen something of a recovery of late. I've got a very pro-business party having been elected. Would this be an area, if you had to pick an emerging economy, I suppose, would this be an area that you feel there'd be opportunity in, Dominic?
Yeah, certainly India. I suppose the only problem is the stock market's already I think it's close to record highs. So I think maybe less of an opportunity based on that. India doesn't come out as outrageously expensive, but it's not outrageously cheap either. So the new government really has to deliver on the sort of business reforms and economic reforms if this sort of rally is going to continue.
And you say, okay, so India's record high, which obviously hasn't really stopped a lot of people in the, I suppose, the developed markets, that has normally been a cue to buy more. The whole buy the all-time high has become something of a strategy for the last couple of years. But you say China's possibly cheap, but not necessarily something you'd touch, and India's a little bit too expensive. What would be your pick of one of the emerging economies to actually seek opportunity if you were to do so now?
I'm actually still very interested in China at these levels. But collectively, I'd like to buy an emerging market fund with a high dividend yield bent, because you can still get some pretty decent high dividends in the emerging world, and there's at least one fund I can think of that tracks that sort of thing. So that is the sort of strategy I'd be going for at the moment. China, I would probably wait for the price pickup to occur, though. It's cheap, but we need a kicker. We don't know what it's going to be, but we know we haven't got it. So I'm happy to sit on the sidelines for now.
Okay, and yourself, what would you think?
I think there's something to be said for the carry trade. Clearly, the market is used to the capital gains trade, equity trades, bond yields going lower trades. There are some high-yielding currencies out there, 6 to 7%. We can get that in Russia, in certain parts of the NDF curve. We can get that in the South African rand. We can certainly get that in Brazilian NDFs. Mexico is a lot lower in yield, so is Poland. But a well-diversified basket of front-end foreign exchange can pay you 5 to 6% yield. And I don't see that there is a huge amount of foreign exchange risk out there over the next 6 to 12 months. So that carry should be earnable without capital loss on the foreign exchange moves, in my view. You mentioned Russia earlier on. You mentioned the ruble. The ruble has come under pressure, but we mustn't forget that the ruble has been the Russian central bank, the CBR, has been intervening to defend the ruble. But for the past 10 years, it is structurally a buyer of dollars, because the amount of demand for rubles is larger than the supply. Therefore, they have to buy dollars in order to supply those rubles. They have an enormous cushion of credibility in order to defend their currency. And of course, we saw large amounts of outflows from the central bank last year when they defended their currency, but they certainly have more ammunition to do so now. And the ruble is relatively cheap. If you believe that we're going to see a pause in the geopolitical risk at the back this year, if you believe that there's going to be some moderation of the tensions, then the ruble is a good buy here too.
And what would be your funding currency?
Well, I think a mixture of euros and dollars. I don't have a strong view that the euro-dollar exchange rate is going to move significantly. I believe that there is quite a lot of lockstep in the core markets policies. Therefore, there's not a huge amount of reason to see a big move in core market cross rates. A mixture of I think a risk-balanced mixture of dollars, euros, and sterling is the right thing to do. I would not fund in the yen. I think the yen, if we look out in hedge fund land, if we look at sell-side commentary, there's a huge wall of negative commentary against the yen, which is typically indicative of over-positioning, and we could see a rally in the yen of 3 to 5% in my view. Therefore, even though the lure of a very low historic yield of the yen, even though the yield on the yen today is just as low, is no higher, is no lower than euros or dollars, there is still a perception out there that one should fund in the yen. I think that would probably be a risky trade.
What do you say, Dominic? What do you think? Would you do something similar?
The only difference would be I'm more bearish on the outlook for the euro. I think it's deliberately what they're going to do is to undercut the euro. I think that's the only way that this project survives going forward. So I do see the euro going down, but it's only a matter of time.
And do you have any sort of level there?
No.
Worth a shot. That's it. Thank you very much.